Well, if you just looked at the Canadian dollar, you might think it's been pretty quiet in foreign exchange markets. But that certainly hasn't been the case. We've seen a rising US dollar and higher US Treasury yields cause a lot of pain in some other currencies, particularly in emerging markets. So simply by trading sideways, the Canadian dollar has outperformed. It's outperformed the euro, the yen, the British pound. And I think the sideways price action in dollar CAD really reflects tension between some shorter term and longer term elements in the foreign exchange markets. On the one hand, you've got higher oil prices and you've got NAFTA optimism that are supporting the currency. Every time Chrystia Freeland flies down to Washington, we see hope return that a positive deal might come out of that negotiation, and that benefits the currency. But the other way to look at it is that without those short-term positive influences, the Canadian dollar would surely be trading weaker. And that's really a reflection of some of the growth headwinds to economic growth in Canada. We have consumers not being able to spend at the same pace they've been spending. Canadian businesses are choosing to invest elsewhere. And our exports are losing market share in the global goods markets. So we think that the Canadian dollar will continue to underperform, trading to the lower end of the range down to 135, which is our one-year forecast.